Hi, this is Lisa of Lisa Guevara Online Bookkeeping, and welcome back to our accounting basics. So this time we are going to discuss about the double entry bookkeeping system. The following are the learning outcomes for this topic. Be able to understand and apply the double entry bookkeeping system in the recording of the financial transactions of any business. Sorry for the typo here. Next, we should be able to understand the key terms used in the double entry accounting. Be able to understand how double entry accounting works in accounting software. Be able to understand the T account. Be able to understand how to read and interpret the transaction journal and general ledger in the accounting software. So what is the double entry bookkeeping system? The double entry bookkeeping system or accounting method is a system used to record financial transactions. It follows the principle that every transaction has two effects, a debit and a credit. So for example, if you buy an office supply for cash, so you will debit the office supply and credit cash. So the value received, your value received is your debit, which is the office supplies, and the value parted with is the cash that you paid for the office supply. So that is in principle the the double entry bookkeeping system or accounting method. So every transaction has two effects, the value the value received and the value parted with, and we call that debit and credit. Debits and credits are recorded in corresponding accounts, ensuring that the accounting equation assets equals liabilities plus equity remains balanced. Okay. So an account, we are going to define this later, but if you will remember in the accounting equation, which is assets equals liabilities plus capital, examples of asset is a cash account, example of liability is accounts payable account, and equity is the capital account. So this one in recording the debits and credits or every transactions uh, affects one or two uh, one or two of of the assets, liabilities, and equity. So every transaction, we should be sure that the accounting equation is balanced. So this method provides a complete and accurate picture of a company's financial position and performance. It enables tracking of income, expenses, assets, liabilities, and equity. This one, income, expenses, assets, liabilities, and equity, these are the elements of the financial statements. By maintaining balance and accuracy, double entry accounting ensures reliable financial statements and facilitates financial analysis and decision making. So now let's go to the key terms in the double entry accounting. So the following are the key terms used in double entry accounting. One is the account. It is a record used to track changes in specific financial element such as assets, liabilities, equity, revenue, or expenses. So example of an asset account is your cash account. Liabilities example is your accounts payable. Equity example is your capital account. Revenue is your sales. Expenses example is your, for example, salaries expense. So those we are going to see all these accounts in the chart of accounts of the company. So this will be divided. The chart of accounts will depend on the kind of industry the company or your business is into. So we are going to take a look at this a little later in the chart of accounts. Debit is an entry made on the left side of an account, representing an increase in assets or expenses or a decrease in liabilities, equity, or revenue. A credit is an entry made on the right side of an account, representing an increase in liability, equity, or revenue, or a decrease in assets or expenses. You will be able to understand this later, how this debit and credit uh, works when we go to our discussion with the T account. But for now, it is sufficient to know that the debit side is in your left, and the credit side is in your right side. The general ledger is a central repository that contains all the accounts and their balances, serving as the foundation for the financial statements. The journal entry is a record of a single transaction consisting of debits and credits that is initially recorded in the general journal before being posted to the appropriate accounts. So for example, if you buy office supplies, you will record this in the journal entry for this is debit office supplies in the amount of $400 and credit cash in the amount of $400. So that would be an example of a journal entry. Next, we have the trial balance. This is a list of all the accounts and their balances at a specific point in time. This is used to ensure that debits and credits are equal and the accounting equation is in balance. Next, we have the chart of accounts. A categorized listing of all the accounts used by a company, providing a systematic structure for organizing financial transaction. So the chart of accounts is basically is these are the accounts that is used by a specific business in order to have a structure in recording their financial transactions. So the balance sheet is one of the financial statements that shows a company's assets, liabilities, and equity at a specific date. This represents the financial position of the business. If you remember, we already discussed this in a separate video about the financial statements of a business. I'm going to link that below so that you'll be able to explore more about the financial statements. So next we have the income statement. It is another financial statement that summarizes a company's revenue, expenses, and net income or loss. over a specific period of time, which indicates the financial performance of the business. The cash flow statement is a financial statement that provides information on a company's cash inflows and outflows during a specific period. It helps to assess the company's liquidity and how they manage their cash. So now let's discuss how double entry accounting works in accounting software. Double entry accounting in accounting software works by automating and simplifying the recording and tracking of financial transactions using the principles of double entry system. So first and foremost, um, once a business has opened or has an account on a specific accounting software, the first thing that they should set up is the chart of accounts. So once you sign up for an accounting software, they will ask you what kind of business are you in, because they have this predefined or customized chart of accounts, which includes various categories and subcategories of accounts based on companies' specific needs. So, for example, if you are an e-commerce business, your chart of accounts will be different from an accounting practice or from a legal practice. Recording of transactions. When a financial transaction occurs, such as a sale, purchase, or expense, the user enters the details into the accounting software. The software prompts the user to select the appropriate accounts and enter the corresponding amounts. So, for example, you paid your bill. For example, you paid your electricity bill. So all you have to do is to prepare the bill. The details, you should enter the details on the appropriate accounts and enter the corresponding amounts. And after that, once the transaction details are entered, the accounting software will generate the necessary journal entries automatically based on the selected accounts and amounts that you entered. This ensures that every transaction is recorded with the appropriate debits and credits. So after the recording, the accounting software will automatically update the ledger, the general ledger, which is a central repository of all accounts and their balances. The debits and credits from the journal entries are reflected in the respective accounts. So it keeps track of the financial changes. So as each transaction is recorded, the accounting software keeps track of the debits and credits in real time, ensuring that the accounting equation remains in balance. With the accurate and up-to-date data in the general ledger, the accounting software can generate financial statements such as the balance sheet, income statement, and cash flow statements. This provides a comprehensive view of the company's financial position and performance. The accounting software often offers a range of reporting options, allowing users to generate customized reports and analyze data. So this helps business monitor their financial health. Okay, so back to reporting. Uh, the accounting software will help track or monitor the financial health of the business track key metrics, and helps the decision makers to make informed economic decisions. So by using an accounting software, the double entry bookkeeping and accounting becomes more efficient and less prone to errors because this software automates the process. It eliminates the need for manual calculations and provides real time visibility into financial transactions and records. So, this also streamlines financial management and ensures accurate and reliable financial reporting. So if you remember in our video about um, the accounting cycle, there are at least 10 steps in the accounting cycle from the analysis of the transaction up to the post-closing uh, post-closing trial balance, right? So uh, these 10 steps are streamlined. So for example, when you are using an accounting software, the only thing that you have to do is to the enter the amount to the right account, and that's it. The journal entry, the posting, after the preparation of the financial statement, the statements and other reports will be made by the accounting software. So, in essence, the accounting software will help you streamline the preparation of financial statements and helps the management to have accurate and reliable financial reports. So now let's discuss about the T account. So T accounts are a visual representation used in double entry bookkeeping to track and analyze the flow of transactions within specific accounts. They resemble the shape of a T, hence the name. The left side of the T represents the debit side, here, the debit side, and the right side of of the T represent the credit side. So this one is the debit side, the right side is the credit side. The account provides a visual representation of the changes in account balances and help ensure that debits and credits are properly recorded and balanced. They are useful tools for analyzing transactions, tracking account balances, and preparing financial statements. So before we go to this topic, how to read and interpret the transaction journal and general ledger in accounting software, I'm going to demonstrate to you how transaction affects um, how the accounts behave in the T account. So I'm going to demo to you what is the purpose of the T account in the double entry bookkeeping system. Okay, so let me hide these controls first. Okay, so now we are going to uh, go to the third uh, phase of the accounting cycle, which is posting. But before that, uh, let me uh, let me show you what are these. So this one, the blue one, is the T account. It is a tool in order for us to mimic the general ledger of the company. So on the left side of your T account is the debit side, and on the left side of your T account is the liabilities and capital. So if you can see, if you will observe, the assets is on the left side, and the liabilities and capital are on the right side of the T count. So generally, your assets is on the debit side. Increases in your assets are on your debit side. Decreases in the assets are on the left side. Increases in your liabilities and capital are on the left side, and decreases in the liabilities and capital are on the right side of the respective accounts. So let's go ahead and post our journal entries now. So the first one is the May 1 transactions. We are going to post the first transaction. We'll debit cash of 50,000 and credit Luna Capital of 50,000. Debit 50,000 and credit Luna Capital 50,000. Okay. So next we have debit cash 100,000 and credit loans payable 50,000. 100,000. Credit 100. 100. So let's okay. So the next one, we should debit office supplies and office furnitures and equipment and credit cash. So debit office supplies 25 and office furnitures and equipment 285. Office supplies. And this one 8,500. And credit cash in the amount of 11,000. So as you can see, decreases in assets are placed on the left side of the account, which is the credit side. So next we have rent expense and cash. Debit rent expense and credit cash of 750. So that would be here, rent expense 750. And credit cash of 750. Next, we have income, debit cash of 25 and credit income of 25. Debit cash. Income. Let's copy this. Of 25. See. Okay. So next we have the same 90,000. Debit cash 90,000. Credit income of 90,000.
And the last one, we have to debit utilities and salaries expense and credit cash. Utilities, how much is that? 2,000. And salaries expense, 3,000. And credit cash of 5,000. Okay. So we are now finished posting all the journal entries. So next we have to get the balances of each of the accounts. Mhm. So if an account has a debit and credit balance, you should get the difference to get the balance of that account at the end of the month. So let me try this one. So that would be this one minus the credit side. So the balance of your cash account is uh this one. So let's double and highlight. And the balance of your office supplies is this one. The balance of your office furniture and equipment is this one. Your rent expense is the same. Utility is the same. And the salary is the same. Mm. Your loans payable, the same. Luna capital, the same. And your income amounts to 115,000. That will be our income for the month of May. Okay, so let's go ahead and add everything. Total assets here. We have cash plus office supplies plus office furniture and equipment plus rent expense plus utilities and plus salaries expense. So we have the total of the asset side is 265,000. Okay, so we have here the liabilities in the amount of 100,000. And your capital here. On capital account, we have 50,000 and your total income. Okay, so that would be plus this one. Sorry. Okay. So our ledger is balanced. So after this, we are now going to prepare our trial balance. So remember that your debits should total all your credits.